Welcome everyone to part 2 of this week's live chat session. As always, these sessions are recorded for playback and you can and should download the slide deck from the course announcements. Use this information to assist with your assignments and to reinforce your understanding of the course content. We continue with our exploration and analysis of Berkshire Hathaway and its famous CEO, Warren Buffett. The immediate reaction of the market to Berkshire Hathaway's announcement of the acquisition of Precision Castparts Corporation, PCC, was negative, as evidenced by a $4.05 billion drop in Berkshire's market value. This reaction could reflect investors' concerns about the price paid and the future benefits of the deal. This decrease in share price poses a significant question. Has Warren Buffett, known for his shrewd investments, made a rare miscalculation, or does he see intrinsic value in Precision Castparts that the market has yet to appreciate? Buffett's investment decisions are often made with a long-term perspective, and it's possible that his analysis of Precision Castparts' financial health, market position, and future prospects goes beyond the immediate financial data and market sentiment. There is speculation that Buffett may have identified undervalued aspects of Precision Castparts, such as potential for operational efficiencies, synergies with existing businesses under Berkshire, or unrecognized growth opportunities that could lead to larger cash flows in the future than currently reported. An in-depth analysis of Precision Castparts' financial data may reveal why Buffett believes that the acquisition will generate substantial value in the long term, despite the short-term market reaction. It is also possible that this acquisition aligns with Berkshire's larger strategic objectives and Buffett's investment criteria. The decline in Berkshire's share price following the acquisition announcement serves as an example of how market sentiment can diverge from the perspectives of individual investors, even one as experienced as Buffett. As you conduct your own case analysis, consider not just the quantitative aspects of this acquisition, but also the qualitative factors, such as management quality, competitive advantage, and industry dynamics that may inform Buffett's decision. Warren Buffett's investment philosophy is often at odds with certain foundational principles of modern finance. His approach provides an alternative perspective that challenges conventional wisdom. The first element he disagrees with is the use of risk-adjusted discount rates. Buffett advocates for using a single risk-free rate to discount the future cash flows of investments, regardless of their risk. This contradicts the widespread practice of adjusting discount rates to account for the risk profile of each investment. Buffett's skepticism towards portfolio diversification is also well documented. While modern finance encourages diversification to reduce risk, Buffett favors concentrating on a limited number of investments that he understands deeply, arguing that over-diversification can dilute the potential for significant returns. His third point of contention is the efficiency of capital markets. Modern finance posits that markets are largely efficient and that it is difficult to consistently outperform the market due to this efficiency. Buffett, however, believes that markets are often inefficient, and these inefficiencies create opportunities for investors to find undervalued stocks. These disagreements with the tenets of modern finance highlight Buffett's unique investment style, which prioritizes fundamental analysis and intrinsic value over statistical models and market timing. Warren Buffett's approach to evaluating investments involves using a risk-free rate for discounting future cash flows, a notable departure from the use of risk-adjusted discount rates commonly applied in financial analysis. This method suggests that he does not subscribe to the capital asset pricing model, or CAPM, which adjusts discount rates to compensate for the perceived risk of an investment. Instead, Buffett focuses on the certainty of the cash flows themselves, rather than altering the rate at which those cash flows are discounted. By matching riskless cash flows with a risk-free discount rate, Buffett essentially treats all cash flows as if they are certain, under the premise that he only invests in businesses with predictable and reliable cash flows. This technique implies that Buffett places more emphasis on understanding the business and its ability to generate steady cash flows, rather than on theoretical risk models. It reflects his confidence in his ability to assess the quality of an investment without relying on market-based risk measures. Buffett's approach prompts a discussion on the tactical aspect of investment valuation, questioning the reliance on models like CAPM, and suggests that a deep understanding of a company's financials may provide a more reliable assessment of risk. Diversification. Publicly, Warren Buffett has often criticized the concept of portfolio diversification, suggesting that it is not necessary if an investor is confident in their knowledge and understanding of their investments. However, a closer examination of Berkshire Hathaway's portfolio, as illustrated in Case Exhibit Number 3, reveals a broad array of holdings across various industries, which on the surface seems to indicate a strategy that aligns with diversification principles. This apparent contradiction raises the question: is Berkshire Hathaway's portfolio truly diversified? When one looks at the major industries represented by these holdings, it becomes evident that while there are investments across different sectors, there is also a concentration in sectors where Buffett and his team have significant expertise. The degree of diversification within Berkshire's portfolio may not follow the textbook definition of diversification designed to minimize unsystematic risk. Instead, it reflects Buffett's practice of investing heavily in areas he believes have the most potential for stable, long-term growth. It is also worth considering whether this breadth is a byproduct of the size of Berkshire Hathaway and the practicalities of investing large sums of capital, which might necessitate spreading investments across multiple industries to achieve meaningful positions. Warren Buffett's success poses a challenge to the efficient market hypothesis, or EMH, which asserts that it's impossible to consistently achieve returns significantly higher than market averages due to the rapid assimilation of information into security prices. Buffett's strategy places a strong emphasis on the value of information asymmetries. He often capitalizes on informational advantages to identify undervalued stocks, which seems to acknowledge that markets may not always reflect all available information in security prices. The efficient market hypothesis would suggest that without an information advantage or exceptional investment acumen, it would be nearly impossible for an investor to consistently beat the market. Yet, Berkshire Hathaway has a long history of doing just that, suggesting that markets might not be as efficient as the theory proposes. One aspect of Buffett's strategy that may contribute to his outperformance is his role in the companies he invests in. Holding directorships in companies provides Buffett with an insight that is not available to the general investing public, potentially granting him an informational edge. Buffett's track record implies that while markets are often efficient, they are not perfectly so. There are moments when markets misprice assets, and skilled investors can identify and exploit these opportunities. These considerations open up a dialogue on the limitations of the efficient market hypothesis and the practical aspects of investing where market inefficiencies, when identified and understood, could be harnessed for superior investment performance. Warren Buffett's approach to valuing and bidding for companies, such as Precision Castparts Corporation, may not always align with market expectations or comparable valuations. His bid for PCC, considered high at the time, reflects his confidence in the long-term value rather than the prevailing market valuations. A critical examination of how Berkshire Hathaway's stock has performed since the acquisition of PCC in August of 2015 can provide insights into the sustainability of Buffett's investment decisions. Despite initial skepticism, long-term performance can be seen as a measure of the validity of Buffett's valuation methods and his ability to gauge a company's future potential. The performance of Berkshire Hathaway stock in the years following the acquisition could indicate whether the market has adjusted its perception of the Precision Castparts acquisition's value and how well the acquisition has been integrated into Berkshire's portfolio. Any significant changes in Berkshire's stock price post-acquisition could suggest how the market judges the success of the acquisition and its contribution to Berkshire's overall value. This analysis not only reflects on the sustainability of Buffett's investment in Precision Castparts, but also offers broader lessons about his track record as an investor. It shows his focus on intrinsic value and the fundamentals of the business rather than short-term price movements or market sentiment. It is important to consider the implications of this case on the assessment of long-term investment decisions and the importance of patience in value investing. Buffett's track record demonstrates that short-term market reactions to investment decisions are not always indicative of long-term outcomes. Next, let's review some important concepts to keep in mind with every case study that you perform. Cash flow is king or queen. This maxim underscores the importance of cash flow in valuing businesses and investments. Warren Buffett emphasizes investing in companies that generate strong and consistent cash flows, as these are indicative of a company's true financial health and provide the resources for growth and dividends. Price does not equal value. Markets are not always and everywhere efficient. The distinction between price and value is central to Buffett's investment strategy. While the market price is what you pay for a security, the value is what you get. Buffett's strategy involves buying securities below their intrinsic value, exploiting market inefficiencies. Value is in the eye of the beholder. This statement recognizes that different investors may have different assessments of value based on their criteria and analysis. Buffett has proven to be a particularly astute beholder, consistently identifying stocks that are undervalued by the broader market. Success entails the creation of value, among other things. Buffett's approach to success is not just about making profitable investments, but also about enhancing the value of the companies within Berkshire Hathaway's portfolio through effective management and strategic growth initiatives. On defining value, Buffett often considers a company's return on equity or ROE in relation to its cost of equity to determine value. A company that has an ROE greater than its cost of equity is considered to be adding value for shareholders, as it is earning more on every dollar invested than it costs to generate that dollar. These core concepts form the bedrock of Buffett's investment philosophy and are exemplified in his approach to the acquisition and management of companies. They offer a blueprint for analyzing investments beyond mere quantitative metrics, looking at the fundamental value and potential for sustainable cash flow generation. This concludes this live chat discussion for now. Be sure to also visit the YouTube video link shown here for another perspective on Buffett's Precision Castparts Corporation acquisition. If you are attending the event live, feel free to stick around for a brief question and answer session that follows. If not, Post your questions on the weekly Ask Questions discussion board or contact me directly via email, voice, or text. See you online.